Hello friends, welcome back to Moneycraft. I am CA Pritish Burton and today is a topic a bit different than what we have been talking in the other videos. That is about recession. We have been talking on so many subjects like investments, personal finance, stock markets, mutual funds and many more. But why recession is the question. The simple answer to this is that always when we focus on investments and we do not know how the economy is functioning, of course, none of us are expert economists, but it is important to know which way the economy is going. So first, let us look into what is recession. Generally speaking, recession in simple terms means that there is a slowdown in the economic activity. Recession is officially recognized by a country when the GDP for 2 quarters is negative. GDP means gross domestic product, that it is the monetary value of all the goods and services that are produced or made within the country during a specified period. Recessions, of course, are not new to our generation. We have seen recession in the year 2007, 8 and 9. There was a downturn in the economic activity, but it did not impact India that much. Recessions are considered to be a normal part of the business cycle. So in order to understand that better, we need to understand the 4 phases of a business cycle. The first phase is the expansion phase. During the expansion phase, you can see a tremendous economic growth, rise in the employment, and there is rise in the consumer spending as well, and so many other aspects. So once the economy reaches the expansion phase, it sees the next one, that is the peak. In this phase, it signifies that the output in the economy has reached its maximum and it paves way for the next phase, that it is contraction phase. So this wave-like pattern in the business cycle now has entered the contraction phase. In the contraction phase, there is less consumer spending. People do not want to go out and spend. There is fall in the employment rates, and also this indicates that the GDP has decreased and also entering the recession phase. The last phase is trough. In this phase, the economic activity or the economy itself has reached its bottom. So once the economy has hit rock bottom, it again paves way for the expansion phase. So in the economy also, nothing is permanent. In the business cycle, one after the other keeps following. Before getting into the various causes of recession, let us get back to 2008 recession. In the early 2000s, there was a real estate or a housing boom in the US. During that period, there was excessive borrowing. Banks kept lending to the borrowers without even looking whether they are able to repay or not. So the borrower's creditworthiness was completely left unchecked. So during 2007 and 8, there was a complete collapse in the financial system because people were unable to repay their loans. And the financial institutions and banks like Lehman Brothers filed for bankruptcy. And this did not remain, or the recession did not remain only in the US, it spread across to other countries as well. And what followed is the stock market crash and also downturn in the economy and a complete collapse in the financial system. So now let us look into the various causes of recession. The first one is the economic shock. Economic shocks are events that are completely unpredictable and which causes widespread disruption in the economy. Just like we have wars and acts of terrorism and even one which we are witnessing currently, that is COVID-19. When economy was booming, nobody thought that we could witness a situation like COVID-19. So because of which there is a disruption in the economy and the GDP has been falling quarter after quarter, and even we are seeing negative growth in the GDP. The next important cause is the loss of consumer confidence. 70% of the GDP depends entirely on consumer spending. When people are afraid of the state of economy, whether they are able to earn or save, so that is when people stop their spending, and that is where it affects the consumer spending and then it impacts GDP negatively, and because of which we also can find a recession coming through. We have seen every government in the world announcing packages after packages, coronavirus relief packages, mainly to revive the economy, to put money in the hands of the people so that there can be consumer spending again, and because of which economy can revive. The next important reason is high interest rates. When the interest rates are high, it becomes very expensive or difficult for people to buy houses, cars and other large purchases. And also companies restrict their borrowings and their growth plans because the cost of borrowing is very high because of the high interest rates, and because of which the economy shrinks. The next cause is deflation, which is the opposite of inflation. Deflation means fall in the prices. So when there is fall in the prices, what consumers do is, instead of buying a car today for rupees 7 lakhs, they wait and postpone their purchasing decisions to the next year, expecting that the same car you will be getting at rupees 6 lakhs. The asset prices fall because of low demand, and it is a natural tendency that when the asset prices keep falling, people wait more or postpone their purchasing decisions for the prices to fall more, and because of which there is no consumer spending, and which impacts the economy negatively. The next important factor is reduced real wages. When the prices of goods and services increase at a faster pace than the increase in the salaries or wages, it reduces the disposable income in your hands. The logic is that instead of spending 50% on food and rent, now you need to spend 60% on the same. So your ability to spend comes down drastically. So the same logic, no consumer spending, then again it takes a hit on the GDP. So basically everything is focused on consumer spending itself. The next simple and the most important factor is unemployment. If the unemployment rate hits a mark of 6%, it has been said that it contributes to recession. Apart from this, there are many other factors that contribute to recession, but here we have looked only to the basic and important aspects that contribute to recession. Now, how do we come out of a recession? So it is basically the governments that step in and fight the recession. So how governments do it is by increasing the government spending. A major component of the GDP is the government spending itself. The government here increases the public spending through infrastructure projects and various other projects, because of which people get money in their hands and they are able to spend more. The other ways to do it is through printing more money, because of which there is higher liquidity, there is more money in the market, and the banks are able to lend so that there is consumer spending. People are able to buy houses. And the other way to do is reduced interest rates. As I said, when there are reduced interest rates, people go in to buy or borrow money from the banks in order to buy houses or cars or any other large purchase. So friends, I hope that you have a better understanding of what a recession is. So why I have diverted from the other topics of investments and personal finance to recession is that you need to understand mainly when there is a stock market crash or to anticipate a small stock market crash. These are the factors that lead to recession, and that is why there is panic selling and there is complete chaos in the stock market. So when you are investing in stock markets, mutual funds, real estate, also keep a tab on what is happening with the economy. Keep watching news and keep yourself updated, which will help you to make your investments better, and without panic you can plan your future better. So friends, thank you very much for watching this video, and stay tuned for more interesting videos on personal finance, economy, investments and many more interesting topics. Thanks for watching. Happy investing.